We'll start off with Costco on pace for its 8th positive week in 9. Baird is expecting accelerating discretionary sales, strong membership numbers, and sustained margins thanks to tight inventory management. Victoria, would you buy this one?
I do. I know Costco has been on a tear lately, but they're one of my favorite stocks in this sector. And on the heels of the great Kroger results this morning, we feel that they're going to have continued supply chain easing. This should help their margins, continuing to boost their free cash flow as well as their revenues and sales. We know their foot traffic and their sales were up in December and January from release numbers they've given us. And we think we've also seen some big ticket items start to move beyond just the increase in sundries we'd seen their consumer spending. I think this stock still has room to run, always traded at a premium to their peers. Absolutely not a cheap stock here, but they're breaking out to new highs. They've broken out of this range, and I think they could see further upside and good earnings under the hood today.
All right, the Costco trade there is a buy from Victoria. Next up, let's turn to semiconductors. Broadcom shares more than doubling over the past year. Cities expecting AI to drive sales, no surprise. Also paying particular attention to demand from Apple as well. Analysts are also watching accretion from its acquisition of VMware back in November. Victoria, do you like Broadcom here?
I do. I also feel like I'd be shot if I didn't recommend buying a semiconductor stock in this AI environment. But look, they had a core chip business. I know we were worried about some slowness in software, in the hardware and their core semi business. But AI acceleration should grow from 15% revenues to 25% revenues. We think that soft demand on the hardware side should continue to grow, and maybe that's bottomed out. So you have growth on the semi side from AI, growth on a better telecom and infrastructure, and then the VMware acquisition. It only took them $69 billion in 18 months, but it's finally done, can start working on the synergies. That gets them the hybrid cloud infrastructure. They plan on investing there. Estimated maybe $12 billion accretion to revenue. I see a lot of upside to the stock, and it is cheap relative to its peers still because it's been a quality stock. It's been already growing free cash flow, growing dividends, growing before this AI mania came in. So I just see that as a positive to an already strong quality stock, and can have them catch up to some of these multiples their peers are trading at. They could certainly have more upside.
All right. And finally, let's go to DocuSign, which broke a 5-week losing streak last week. Jeffrey's watching enterprise demand and competition as last month's rumors of a buyout did not come to fruition. The company also cut 6% of its workforce in February. Would you do with DocuSign here?
Look, DocuSign's a sell to me. The only reason you hold this stock is for some hope that somebody takes it private. That obviously fell apart. I don't like how many times they've had to restructure and cut staff. And most concerning to me is that the revenues are falling for a high multiple stock. You're not seeing the growth in revenue to justify this multiple. And the staff that they cut are from the sales and marketing side. So if we see slower demand, if we see, especially in that core 300,000 revenue plus segment of their book, which has been slowing, that's a huge segment of their book we may see under threat. And I don't see their competitive moat as strong. I feel like they may continue to lose customer base, and this is just not a stock I'm excited about.